Howdy there, folks. Welcome in. It's a buy one, get one free here today in this video. First video up here. The market right now is gambling on an unlikely Fed rate cut. I thought that would be an interesting one for me to react to, give my perspective on there. Okay, second video we're going to react to is stocks are stuck in purgatory with current Fed environment. Zoe Financial CEO. And so what do they mean by that? Do they mean like we can't go up because of what the Fed's doing right now? I would love to hear their perspective and kind of share my perspective as well. First off, thank you everybody that's subscribed here. We are now officially over 25,000 subscribers. So I appreciate each and every one of you. Also, everybody in the Patreon squad, I received so many messages over the past like 48 hours that a lot of you guys were trying to get in the new Discord tier we just launched, and you were having trouble with that, or you joined and then you didn't have access inside the Discord, and just all types of stuff. So I had T-Man put together like entire, basically step-by-step on how to do it. There's 5 different photos there that takes you through the whole process there, so that should help you guys out there, okay? Appreciate everybody as always, and let's get straight into this.
Greenhouse of Solus Alternative Asset Management, Victoria Green of G Squared Private Wealth joining as well. Also a CNBC contributor. It's good to have you both with us. Dan, I'll go to you first. Do you have expectations of cuts by the Fed? Because since we left it with Timorous there, let's entertain that first, because more people seem to.
Yeah, I don't know. To Nick's point about how long people have been calling for rate cuts is apropos of the situation now, in the sense that it's been probably about a year that people have constantly called for rate cuts. And truthfully, when you look back 25 years...
Not really. That's not the case at all. I mean, the first time we've really started to hear about rate cuts or people calling for rate cuts has really been this year. You've had a few folks jump on there, right? The professor's been kind of jumping on that train recently. Elizabeth Warren started jumping on that train recently. But prior to that, no one's really been talking about rate cuts, to be honest.
Street is notoriously bad at forecasting where the Fed funds rate's going to be. Every time it's going up, each successive rate hike is the last one. When it's coming down, each successive rate cut is the last one. My gut is that inflation is still pretty high. The issues with the banking sector right now are largely idiosyncratic. I don't think there's a systemic issue in the sense that people are using the word systemic, and that the imminency of rate cuts is probably a little too much in terms of pricing.
Are you surprised by how the market has held up? I mean, just given all that's happened. The equity market. Yeah. I mean, stocks were up last week.
Yeah, I mean, listen, I think certainly it's been a pretty strong run. I mean, credit spreads have widened out a little bit. You've had tremendous moves in the futures market, in the treasury market, in terms of rate hikes and rate cuts. I will say, with respect to the Nasdaq, which is where everyone's focusing,
and rightly so. It's the way that tech stocks have just jumped ahead of everything.
Sure, but I spent a little time. When you dig beneath the headline, it's a little weaker than the headline suggests. So, like, for instance, if you break up the Nasdaq into quintiles, only the top quintile is up. All 4 of the other quintiles are down. The cumulative advanced decline line, how many stocks are going up versus how many are going down.
Okay, I got an interesting game to play here, okay? I want to go to my big tech watch list, and we'll go through each stock and we'll see, are they up or down year to date? So let's go year to date. Start out right, we'll just sort this worst stock today. Okay, AMD, 47% year to date. Oobity Booba stock, 18% up year to date. We got Intuit, 7%. Shopify, 24%. 13% Google. Tesla, 75%. Netflix, 9%. Meta, 60%. Palo Alto Networks, 37%, Micron, 17%, PayPal is down. Of course, you could kind of throw that one into fintech as well, right? Amazon, 13% up. That's QQQ. NVIDIA, 84%. Wow, NVIDIA beating out Meta and beating out Tesla. Interesting. Mr. Softy, 14%. Apple, 26%. Snowflake, down 6%. Okay, that one's down. Adobe, 10% move there. Intel, 9% mover up. And then we got CRM, Salesforce, up 42% year to date. So only 2 stocks were down, Snowflake and PayPal out of that bunch there, right? But once again, that is kind of the top, the bigger of the techs. So I think he's talking about a lot of the smaller techs might not do it as well. But I don't know, I have a question about those too, because a lot of those stocks kind of fit like the Cathie Wood type stocks. And to be honest, look at ARC Fund, right? So I don't know. A lot of those stocks are doing well as well. Interesting.
Has come straight down while the market's gone up, and the percentage of the market that's in an uptrend has declined as well.
Yeah, well, the heavyweights punch the hardest.
Yeah, but yes, for sure, they have the largest weighting in a number of indices. But at the same time, we shouldn't be lured to sleep, so to speak, in saying that everything is all well in the NASDAQ or the S&P or wherever, if most of the carrying is being done by the top portion.
So, Victoria, I mean, you have been more bullish than most of late. I think you even declared to me on this very program that we were in the midst of and the early stages of a new bull market. I'm wondering if you're reconsidering that, given the events that we've had over the last few weeks.
Yeah, I might want to walk it back a little bit, but honestly, it's been quite like we call a Teflon market. And as you pointed out, the heavyweights are punching hard. We've seen the resurgence of mega cap tech, but they're also being supported by a weaker dollar and the potential of a Fed rate hike, which should help growth stocks. So for us, we're kind of moderately, just a tad bit bullish, but mostly neutral. I think the next 30 days, we have a little reprieve before the Fed goes in early May, and we've got to see what happens. What happens with PCE this week? We'll go back to data watching. We'll see if we have another bank failure or not. But I don't think the Fed is ever going to signal hikes unless they feel they really have to. They're not going to make a policy change like that on a guess or a, hey, we might cut rates. They're only going to announce a rate cut if things have gotten so bad they feel that is the only option left on the table. So I don't think you're going to see it telegraphed. So the market right now is gambling a little bit. I don't think the Fed is going to cut unless they really see the banking contagion continue to pick up.
I'm just wondering how you
contagion pick up, and the other thing she's not taking into account there, in my personal opinion, is a scenario in which you see inflation continue to drop. Let's assume we're in the threes this summer. Let's assume we get a little bad economic data. Unemployment goes up, let's say 2 months in a row or 3 months in a row or something like that happens, right? Cut. It happens like that, man. Because at that point in time, Fed funds rate would be significantly. Let's say I'll just throw numbers out, okay? Let's say it's July. 3.2% CPI. Is that impossible to imagine? Not at all, okay? 3.2% CPI July. Okay, if there's a scenario where, let's say, unemployment's gone up 2 months or 3 months in a row for whatever reason, right? Or some sort of other economic indicator is not quite looking right. That's a moment the Fed says, okay, we'll cut 25 basis points or 50 basis points or something like that, okay? So it can happen a few different ways in regards to potentially cutting. And I'm not banking on that. I'm just saying, like, there's ways that the Fed would cut. And we know the Fed's quick to act if there's any sort of issues specifically around employment.
Can still be a tad bit bullish. I mean, I'm not suggesting that you shouldn't be, but if you don't think the Fed's going to cut, if you're still concerned about what lies beneath, so to speak, what allows you to even be incrementally more bullish than bearish?
One, you didn't see the technicals completely break down. Yeah, we're in purgatory, no man's land, so we still have some solid supports in there. Number two, I do think stocks sometimes run when they're not expected. If you look at how this market reacted, the financials and the energy sector sold off, but you saw almost everything else unilaterally hold up well. I do think you need quality, you need cash flow, you don't need companies losing money right now. I think you need to be prepared for a little bit of belt tightening, but we're seeing that. We're seeing layoffs, and we're seeing the investors reward companies that are making hard decisions in order to protect their profit margins. And we see profitability. I think when we get into Q1 earnings, honestly, outside of financials and potentially energy, who do you think is really sucking back? We've seen continued spending. We've seen people travel. We've seen people eat out. We've seen people continue to shop. So if you look at the consumer and the health of the country, I know we're all expecting this horrible data deluge, but it's just not coming. We've seen continued strength.
Yeah, it was interesting. Today, it was like 10:30, and I was like, let me go to Starbucks, So I was like, okay. So I drove down to Starbucks, expecting to just, get a coffee drink, coming back home. And I got to Starbucks, and the line was 10 miles long. And I was like, I thought everybody was out of $6 to buy a Starbucks. Joe, man, what happened here, okay? And I drove back home. So nonetheless, I was like, I'm not waiting in that flipping flapjack in line. So anyways, that's just kind of the data you look at. You go to, try to go to a lot of restaurants on the weekends and whatnot. It's just like a super long wait still, and it's like, what's going on here, man? Because we're supposed to be, all these recession predictors and everybody's supposed to have economic doom, and yet the world keeps spinning. So anyways, we'll see. Next one up here, stocks are stuck in purgatory with a current Fed environment.
Buying the rally that we're trying to build over the last 4 days or so, and warns that the Fed may have to cut rates sooner than later, and says that's actually bad news for stocks. Let's bring in Andres Garcia Amaya. He's the CEO of Zoe Financial. Andres, people have been chasing tech stocks and Bitcoin and all the rest of it, and this idea that maybe a rate cut is a good thing, a liquidity pivot. What would you say to that?
If we look at the last couple times the Fed lower interest rates, stocks didn't do well during that period. Why? Because usually the Fed's kind of catching up to what's happening in the economy. They're on the growth side or the inflation side. So if the Fed were to lower interest rates to try to help financial stability, I don't think that's good for stocks. If the Fed were to lower interest rates because they beat inflation, maybe that would be a different story. But with inflation at 6%, I don't think that's going to be the case this year.
Yeah, well said. It's also in your...
Come on, man. It's not going to be a 6% all year, dude. I hate to tell you. What are we talking about here? We're on our ways to the 4s, and then we're on our ways to the 3s after that, okay? That's what's going on there.
Sizing that we're so obsessed with the failure of SVB today, obviously. But to you, in some ways, that was a macro event. That was a markets event. And the scars, for instance, of what happened in the 2-year, that 3-day plunge, you think that's pretty telling, no?
Absolutely. I think the bond market reacted a lot more stronger than stocks this time around, basically telling us the Fed's going to have to blink. Right? If they went from solely focused on price stability to now financial stability, the bond market tends to think now that they're going to have to focus more on that financial stability. Stock market didn't react as harsh, right? I think the stock market is trying to see if this event on the regional banks becomes just kind of a history lesson rather than something much bigger.
You make the argument, we've heard from other voices here in the same vein. Paul McCulley is now very much in this camp. Why do you think that no Fed officials themselves,
Big subject. Damn it, we got to cover this, okay? It is a big subject. Why didn't the stock market freak out over what happened with SVB and the other financials that have gone down recently? I think it's a fair subject, right? Why didn't everybody freak out? Didn't the VIX spike to 35, 40, 50? If it was past markets, it would have done that. I have the answer to that, okay? What we went through in 2020, it basically gets no more severe than that, right? We literally had a once-in-a-100-year pandemic where we were talking about shutting down the worldwide economy, and everybody was uncertain if business was even going to transpire, if all the companies were going to go out of business or something like that, okay? When you had worst-case scenario, everything from there gets less and less and less, right? So then we had a second dramatic scenario. The first W situation, okay, in Europe since WW dose, okay? Think about that for a moment. Oh my gosh, how insane is that to think? Since the 1940s, we haven't had a scenario like that. So we have a once-in-a-100-year pandemic. We're the first W over there since the 1940s. Oh my gosh. And so the market becomes desensitized to scenarios. So when you say, okay, a bank failed, this bank failed, whatever, right? No one ever heard of SVB Bank, let's be honest, prior to 3 weeks ago, essentially, right? Signature Bank, no one ever heard of that. Like these are banks that, these are not JP Morgans, these are not Wells Fargo, Bank of America, that you could say, and everybody's like, oh yeah, I know them, right? And so with those go under, the market kind of is so desensitized because it's been through so much traumatic experience that it's that's nothing. Oh, that's all that's going on? And so that's why you didn't get this huge VIX spike that the bears had predicted, right? That's why you didn't get, oh my gosh, everybody's got to sell the S&P 500 off 5, 10, 15, 20%. You would have got that in past markets. But when you're so desensitized, investors are just another thing. Big deal, okay? We're mentally on just a different level because of the trauma we've had to go through over the last several years, including inflation that went to the highest in 40, 50 years. It's incredible. Consumer confidence that went to the lowest we've ever seen in history last year. Think about the trauma we have gone through. So at this point in time, Oh, wow, bank failed. Oh, wow, the FDIC is going to have to step in. For us that are experienced investors, we're not freaking out over that. That's why the market didn't move. For other people, they were all so into that, right? For us, it's like, just another thing.
And to them, you'd sort of think it was a very different economic reality. Why?
I am so glad I'm not in those seats right now, because everyone's crystal ball just got a little bit hazier, right? Once the financial stability concerns become larger, I mean, we learned how quickly the world could change in 3 weeks, right? So I think they have a really tough job of basically having that price stability goal not going away. Because, I mean, imagine if they say, okay, forget inflation, even if it stays at 6%, that's not good either. Right. So I think they're now stuck in a hard place with no easy decisions.
I mean, they could get up there and say, hey, everybody, you know, inflation's already receded by a third. It's falling almost as quickly as it rose, and we expect it to keep turning.
The Fed doesn't need to cut rates right now. The Fed can cut rates this summer if they want and just start cutting rates. They can do it in the fall time. They don't need to cut right now, okay? That's the bottom line with that. I mean, that's just ridiculous. They're not going to cut right now. If they cut, it'll be in a few months from now. Like I said, if they start seeing, if we hit something with a 3 CPI, that's a moment the Fed can start considering cutting rates, okay? Or if there was something more significant happen in the financial system, that's a moment the Fed could consider cutting rates. But outside of those two scenarios, they're not cutting. That's just ridiculous.
Look at the home price data this morning. They could choose to start building that narrative, say people, we're not doing this in spite of inflation. We're doing it because inflation appears to be heading way back down. But I don't know why they just don't seem to want to talk about that.
I think the issue is that if they do that and they're wrong, right? Let's say they start lowering interest rates and core CPI stays elevated. Okay, are they going to go back to hiking interest rates in an environment where a recession is a danger, right? So I think they're just stuck between not really good options left on the table when it comes to price stability.
Yeah, it's just odd.
They're fine. They're fine. Keep rates where they're at for now. Like, there's no need to raise. There's no need to cut right now. And like I said, CPI comes down to the 3s, let's say this summer, or a worst case scenario in the fall. Boom, at that point you can worry about cutting. They don't need a cut right now. The market's not telling them they need a cut. We're not seeing anything else happen systemically in the financial system right now. And so at the moment, for like the next few months here, just keep rates where they're at. Don't raise, don't lower, don't do a thing for now, okay? And when CPI comes in line, then at that point we can say, okay, now we can consider starting to slowly cut rates.
You know, people in the markets go, we see the accident forming. We think the Fed probably knows it, but feels like, they can't really communicate. You know, they'll just err on the side of causing the accident. It's just odd. So what would you do with markets or investments or strategy at this point, let's say for the next 6 to 12 months?
Yeah, and that's the key, right? Important to caveat here. If you're investing for retirement 10 years out, I think you don't make any drastic changes, right, to your allocation. If you're looking out the 6, 12-month horizon, I think that we're just going to expect a lot more price instability on the markets, not just on inflation. And what that basically means is stocks basically stuck in purgatory. I don't know if we're going to break through October lows, but I don't see any environment right now, like the ingredients for a bull market to emerge.
What then would you do? So T-bill and chill was the refrain until it kind of blew up the economy. So what would you do with, for instance, those still high yields on anything from 6 to 1, maybe you could call it 2 years? I mean, where do you think
we definitely have seen the importance of cash management becoming part of asset allocation. And what that basically means is a lot of people didn't realize that they were making, 1% or 0.5% on their cash. So that becomes a key part, right? Talk to your financial advisor. A lot of people find surprising that they can make 4 or 5% on their cash right now. So a lot of that's going to happen, which, by the way, is...
Or instead of contacting a financial advisor, you could just do your own dang research, spend 30 minutes, an hour doing some research, maybe a couple hours. Oh, that would be phenomenal, wouldn't it? Oh, gosh, that's the same amount of time you'd spend with your financial advisor, right? Why don't you be your own financial advisor instead of... anyways, I don't want to go off on that
with the regional banks, right? Mm-hmm. Deposits were so low, that's where the money started to come out, is because there's better options out there in places like money markets.
But you would endorse moving it to those higher yielding areas?
Let's put it this way. It depends on your current situation, but some people didn't even realize that was an option, right? I know we encounter a lot of times people that are still sitting on checking or savings account yielding 0.5% or 1%. right? So there's still a lot to be done there without having to shift everything away from stocks or bonds to generate better return.
I do love the point he made right there. I do love the point he made about you could do, things with your cash that are better than, let's say, keeping in a checking account that's getting you nothing right now, right? Savings accounts, depends on where you're at. Some savings accounts are yielding really good right now, depending on where you're at, right? I know Ally's yielding very well. Some CD accounts are yielding very well. You have treasuries as an option if you kind of want to lock up money for, 3 months, 6 months, 12 months, something like that. So there's definitely a lot of options, and I appreciate him bringing out that. But I mean, do a few hours of research. I mean, you don't need to contact somebody and how do I do this? Like, if you got a brain that's like right here and you use your computer and do a few hours of research, you'd be amazed at what you can kind of figure out there. And oh, wow, I can move my money to this savings account and they got 4%. And it's FDIC insured to 250 and blah, blah, blah. You know what I mean? You could do your own kind of due diligence there, in my opinion. So appreciate everybody as always. Thank you for joining me. Thanks for being subscribed. Much love as always. Also, everybody in the Patreon, don't forget, if you're looking to access all that, I got the whole screenshots there. T-Man put that together for us. So definitely check that out. Much love and have a great day.